Good morning, everyone. David Moore, IRA Advantage. Thank you for joining us today, and look forward to speaking to you. I was going to say speaking with you. That's one of the downsides of being online with these webinars. I miss being in a room full of you guys because it's always fun to be able to have that interaction. And we are going to be doing the one in person probably next month. But at this time today, it's all online, and today's title is Record Funds Are Leaving Wall Street. What options do you have? So we're going to talk about self-directed IRAs, solo 401k plans, the options that you've got to use those funds off of Wall Street. And I just want to start off by saying this is not something new. This is something that's been possible since the founding of retirement accounts in the 70s. And it's just one of those well-kept secrets, and it really continues to baffle me at how little information there really is out there on this whole process. So once again, we're going to talk about self-directed IRAs. We're going to talk about basic IRAs, checkbook IRA or IRA LLCs, and we're also going to talk about solo 401ks. We're going to talk briefly about something called a rollover business startup. But I guess the biggest thing is recessionary times. People like tangible assets. We all hear the ads for silver and gold, but I'd say real estate is the ultimate tangible asset. And the thing that always frustrates me about any of those, tangible assets, if you look at it in the from the definition of the Wall Street world, they're all considered alternative investments, which, if you think back on what caused the crash last time, synthetic derivatives, I mean, what are those things? They're a legitimate investment. They're a real investment, let's say, and we've got real estate that's possibly the oldest investment known to mankind, and it's considered an alternative investment. I just sort of think that makes it sound less than. And even the association that deals with these assets is something that was talking about alternative investments. So once again, we're going to talk about the basics of it and how to get started, what to do with them, and hopefully you're going to get some good information out of the class today, little nuggets of knowledge. If you've been on my classes before, you don't have to understand it all, but you have to understand you've got a source to get those questions answered. And I'd like to say that if you happen to be in Oregon, you want real estate, if you're a real estate professional, you want CE for this, it is 1 credit hour for Oregon Real Estate CE. And you can reach out to C Moore at IRAadvantage.net, C Moore, M-O-O-R-E at IRAadvantage.net. She can get you credit hours. If you're not on our mailing list, take a look. The other thing I do want to mention is please take a look if you've got questions on different aspects of this, and this presentation will be up on our YouTube channel too after we're done. So if you, I have a tendency to get excited and speak quickly. So if you miss something or you say, hey, gee, David, I wish you could slow down a little bit, you can always go back and hit replay on different aspects of this presentation on the YouTube channel, but there's a whole variety of different videos and different aspects of IRAs. And if you have questions on 1031, go look at the sister channel, Equity Advantage 1031 Exchanges. And we try to get good content up there that's going to answer questions you may know or you may not even know to ask. So if you're looking for information on something you don't see it online, please reach out to Celia. It's, once again, see more at IRAadvantage.net, and we'll create some content to take care of those questions. So let's get going today. We've got a lot of info and we've got a little time to get through it. Always those first clicks on the presentation start. Takes me a couple of clicks to get it going. Okay, I got a big fat stop sign on here. And if you were on yesterday, I did a presentation on 1031 exchanges, and I had the same picture right on the first frame. And the reason I've got this thing up there is, the old saying, fail to plan, plan to fail. And, the idea is you better have a roadmap of the future. Self-directed retirement accounts, I'll just tell you straight up, it's easy to get upset with your financial advisor about what you did or did not invest in and say, gee, why didn't you do this? Or why did we do this? In a truly self-directed retirement account context, the buck stops with you. So you need to understand that these things are something without guardrails, and you need to really, think about what you're doing with them And we're going to break it down to that old KISS principle like I do with 1031s in a few minutes. But the idea is really ask the questions, look at what's going on before you jump into this pool, because it really opens up any investment, literally any investment the law allows. But it's up to you. If we've got a solo 401k or a checkbook IRA, for example, you have the power of the pen. You make the investment that you want, when you want, as you want. And if you want to screw it up, you can do that. And what I mean by screwing it up is with a prohibited transaction with a self-directed retirement account, your Wall Street world investments, there's really guardrails there. You can't commit a prohibited transaction. When we've got a self-directed account, those things are possible. And you think, well, gee, what's a prohibited transaction? We're going to talk about those in a while. But this is how simple it is to commit a prohibited transaction. So you give us a call, and we advertise on the radio. So people call up, they say, well, gee, I've been hearing you for years, and finally it's like it goes in. I laugh about the radio, whether you want it to go in or not, it does. But you've heard us talking about things that are possible. And so you decide, hey, I'm going to do it. And maybe you found that piece of property if you want to buy real estate. And honestly, our background is investment real estate. And my brother and I founded a company, Equity Advantage, handles tax deferred exchanges in 1991. And we had investments before that. And the IRA business we put together because of our 1031 clients expressing their desire to take more money and get it into real property. And so we put IRA Advantage together, I don't know, 15, 20 years ago now. But it's one of those things where we did it to accommodate our investors' desires. And if you've got Wall Street investments, like I said, you got a financial advisor there, you can only make the investments on their investment menu, and it's really impossible to commit a prohibited transaction. If somebody wants to go out and buy real estate, which typically people come to us, they want to buy real estate, they want to make loans, buy notes, they want to do a business startup. Maybe they're, you're going to cringe at this, but crypto, right? So crypto depends on what year, what month, what day, what hour of that day, whether it's good or bad. But those things, if we're buying real estate, you might find a piece of property, you might have heard our ads for the last few years. You say, well, gee, I'm going to tie it up personally. And then just at a later date, we're going to assign this thing over to the retirement account when it's set up. That would be a prohibited transaction. There's a benefit to a disqualified party. So you cannot personally tie up an asset and then assign that purchase sale agreement over to your retirement account at a later date. There's a benefit to the retirement account because you took the property off the market. So when we're looking at prohibited transactions, if there's a benefit to a disqualified party, that constitutes a prohibited transaction. We're going to talk about all of this, so don't worry about it if you're going, gee, what the heck's he talking about right now? So we're going to break it down into, basically two different issues, and we're going to talk about this. But my golden rule with retirement accounts is do not think about that money, the retirement money. Do not think of the assets that money is used to buy as yours. If you think of it as yours, you're going to have a problem. So I always say, hey, think of it as Susie down the street. You're not going to pay for her stuff. You're not going to buy her stuff. You're not going to take her money. You're not going to put an insurance policy on her property. And that's sort of the best way I can sort of express to stress the importance of separation. If we're doing a checkbook IRA, for example, we're sticking an IRA specific limited liability company between the trust company and the ultimate investment. When I ask people, when we're putting these checkbook IRAs together, I ask somebody for a name, a potential name for that limited liability company, and often they'll use their name in it. And I say, well, we don't want your name in it because I want you to think, especially if you had a debit card for that account, I want it totally clear. You pull that debit card out or you look at that checkbook, you know it's not you. So have fun with the name. Create a name that really says, hey, gee, every time I look at this thing, I know it's not me. I'm not going to be doing something that could be that could constitute a prohibited transaction. So this big old stop sign is here. It's critical. The reason it was on the 1031 presentation yesterday is even though 1031s are over 100 years old at this point, we have people selling a property, then calling us up wanting to do an exchange, or they go and buy a property because somebody told them they could do a reverse exchange. They buy it, and then they call us up. These things can't be fixed. So in a 1031 context, if you go out and buy a property to replace something yet to be sold, because somebody said, well, hey, just do it now, you can buy it and just do a reverse exchange, you cannot legally own the new and old property simultaneously. So it's critical that you stop, Anybody out there that scuba dives, the golden rule with diving is if there's a panic, a problem situation, the first thing you do is stop. And I'm going to tell you that with the investments too. I mean, any investment, yeah, you're doing yourself a disservice if you just race into these things. Really take the time to plan what you're doing and get things set up to go before you're getting behind the 8 ball. Do not put the cart before the horse. All right. I'll get off my soapbox. So tangible assets, and it's really, we've had the exchange business for, since 1991. So we've had several different recessions we've gone through there. Recessionary times, what happens typically is the 1031 business slows down and our retirement side of the business increases. And it's just because there's a flight to quality. Tangible assets are the ultimate inflationary hedge. And I'm going to say, I'm a real estate guy, right? So I'm going to tell you that real estate is the ultimate tangible asset. I was taught when buying investment property never to bank on appreciation, and with real estate you don't have to. I mean, I've got had a wonderful friend. He's now deceased, but he said there's one golden rule of investing in real estate: do not sell during a recession. And during recessionary times, maybe those with the gold have the advantage there, right? Those with gold make the rules. Those with the gold can take advantage of opportunities. Recessionary times, some people sit down and take a vacation. They go away, as one of my mentors used to say. We've got an article called Recession Investing, and it starts off by saying you might be one of the people that you go into recession, you go hang out in Hawaii on the beach for a few years till it's over. On the other hand, any change in a market creates opportunity. And so the question is, how do you take advantage of that opportunity? And the Wall Street world, you've got liquid assets. You don't like a stock, you sell the stock, right? You can go in and out and stuff. Once in a while, I'll have somebody with a 401k plan that doesn't allow people to go to cash, which is a tough thing. And during the last crash, I actually had a guy, at least one person, quit his job to get access to his money. He said, look, if this market crashes, I can't afford to work for the next decade to get back to where I am. And my plan won't allow me to go to cash, and I'm scared. So he quit his job to get access to the money, because unless you're 59 and a half, you can't get money out of a 401k plan if it's a current employer plan for you. So the guy literally quit his job to get access to money. That's how concerned he was. But in Wall Street speak, those things are all liquid assets. They look at real estate as a non-liquid asset, which, the upside of being non-liquid is you got more stability. You're not looking at the stock market all day, every day while I'm in the office. I've got, business channels on the screen in my office. I'm watching what's going on with stock market, everything else that's going on, for a variety of reasons. But, if I'm looking at real estate, you're looking at longer time horizons. Things happen more slowly. So inevitably, it's a more stable asset. But in Wall Street speak, they say, well, gee, it's not a liquid asset. So we're going to get to a page talking about common objections to doing a self-directed account. One of those is the lack of liquidity, let's say in an RMD, required minimum distribution context, because at 72, you've got to start taking money out. You've got to take those RMDs, required minimum distributions. And what happens if your self-directed account doesn't have any cash in it, and you by law have to take that distribution? Well, in their world, it's say, well, gee, you're going to have a penalty. Our world is a simple solution to that. You just take an in-kind distribution, which means you're taking a piece of an asset out as a distribution, which has a variety of benefits, which we'll talk to in a little while. But anyway, unlike precious metals, and we all hear the ads for precious metals, we see them on TV, hear them on the radio, and that's probably the most common thing people think about when we're looking at tangible assets, where real property is the ultimate tangible asset. You're not banking that it's going to go up. Somebody else is making the payments for you the whole time you've got it. It doesn't have to. You're not banking that the thing's going to go up in value for your return on investment. So self-directed account, it's not a legally defined term. It's just a term that describes an account that allows you to do what you want to do. And from our context, you hear people talking about self-directed accounts. I was looking at some paperwork, reading something online the other day with a financial firm, and they kept referencing self-directed IRA or self-directed 401k. Well, I know what that company does, and those are not self-directed accounts. So typically the sole self-directed term gets used incorrectly, I would say, all the time. And they're saying, well, gee, you have the ability to select from their menu of investment options. Our definition of a self-directed IRA or 401k plan is something that's truly self-directed, meaning that that account is going to allow you to make any investment the law allows, not just Wall Street investments. So the way the investment menu truly works in the self-directed world is this, and once again, these rules have never changed. By law, an IRA can buy literally anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. A 401k plan can buy anything other than collectibles. So if you've got a 401k plan that doesn't allow you to do all the stuff we're talking about today, the reason you can't do it is the plan document or whoever's that third-party administrator, what they're doing with it. Okay, it's not by law, it's by that plan. If you're talking about an IRA that does not allow you to buy anything we're talking about today, you might be working with the Wall Street firm with their self-directed IRA. It's not. You know, if it doesn't allow you to make loans, buy notes, buy crypto, buy real estate, all of these things, it's not a self-directed account. It's Wall Street's version of it, but it's not a truly self-directed IRA. So I really want to stress the difference between a truly self-directed account and some brand relating self-directed. And the menu of investment options is almost limitless. And once again, these laws have not changed since the inception of retirement accounts. So everything you need to know, I like it simple, right? So if you were on the call yesterday, on 1031s, I break 1031s into four basic components. One, it's got to be an exchange. Two, what's given received have got to be of like kind. Three, you're going across or up in value and equity, and we call that the napkin test. I want to stress I didn't say anything about debt. So in a 1031, there's all this erroneous information out there saying you got to replace debt in an exchange. You don't. Debt can go away by going down in value or by adding cash. Adding cash is fine. Going down in value is not, because you went down in value. And then finally, we've got to have continuity investing. If we're looking at retirement accounts, I look at two issues. This is all there is to it, all right? So once again, that first slide said stop, don't do anything until we're set to go. You got to understand the rules and be ready to do it. But when you get down to the operation of a self-directed account, really the questions are, what do you want to buy? And who you're transacting between or for the benefit of this. Two issues, period. That's it. And as far as what you can invest in, it's anything with an IRA, anything other than collectibles, life insurance contracts, or stock in a sub-S corp. If we're talking about 401k plans, literally anything other than collectibles is fine. So rarely is the investment a problem. And I mentioned about, say it again, if it's not specifically prohibited, it is therefore allowed. And that's the way it is with retirement accounts. So rarely is the investment a problem. What typically causes a problem is a transaction between or for the benefit of a disqualified party. So what does that mean? You couldn't buy from a disqualified party, buy to, sell from, loan to, borrow from. Who's a disqualified party? And those would be lineal ascendants, descendants, their spouses, or any legal entity owned in a controlled interest by one of those. So, and I also want to stress, you can transact along with a disqualified party. You just cannot transact between or for the benefit of one. So you might ask, what do you mean, David, transacting along with? Well, what I mean is that if you've got, X dollars in your retirement account, you need, Y dollars total to make a given investment, you could be a co-owner along with your retirement account of a given asset. So it's possible to combine personal money and plan money in a common investment. It's actually even possible to combine a 1031 exchange into an asset along with something that you're going to buy with your self-directed account. Now, in that structure, if we talk about joint ownership with those two entities, qualified and non-qualified money going into a common investment, typically you're going to have two choices. You could do it as common members of an LLC, or you could do it tenancy in common. If we're looking at a 1031 combining that money along with the IRA 401k funds, that's going to require tenancy in common, not because of the retirement account side, but because of 1031, and 1031 specifically prohibits the exchange of a partnership interest. So depending on what you're doing, what you want to do, if you've got an idea, don't think, I always say the only dumb questions that you don't ask, the one you don't ask. If you've got an idea, you've got a question, give us a call, talk to us, and don't hide behind the keyboard. We'll go back and forth all day long trying to get to the bottom line on something. You give us a call, we can talk the thing through very quickly. There's no cost or obligation to that, so give us a call. So with what we've said, why are people looking at self-directed retirement accounts? Why would you do that? And the title is talking about money leaving Wall Street. Recessionary times, it typically gets put on the sideline or goes out, and that's what we're seeing, all right? So if we look at why they're doing it, they're tired of the stock market's roller coaster. Once again, back to that liquidity comment I made earlier. The real estate takes a while to buy or sell. It's going to be there. Changes are going to happen more slowly. Where Wall Street, they say never to buy or sell on news, but inevitably what happens? I mean, it drives me crazy, right? You think, okay, well, they should have baked in the interest rate increase. We knew that was going to happen, and boom, it hits, and all of a sudden the market changes. So you say what you want to say, but that Wall Street does go up and down. That's just the nature of it. And once again, timing the market is it could be a very good or very bad thing for you. Anyway, we're talking about tangible assets. Typically, the changes occur much more slowly. Greater financial control. You do what you want, when you want, as you want, and you're not banking on something going up in value if you buy a piece of real estate, for example. Invest in what you know. If you've got specific knowledge of something, and you gotta love memes in today's world, right? So I always jokingly say I'm not Martha Stewart's biggest fan, but come on, is she the greatest, highest culprit of insider trading on Wall Street? Absolutely not. You could probably take anybody in the House or Senate. They're much more in violation of insider trading laws. But if you have specific knowledge of something on Wall Street, are you legally able to take advantage of those things? And the answer is no, it's insider trading. On the other hand, if you're a mortgage broker and you want to have a self-directed account and you want to provide loans to people, can you do that? And by doing that, would you hopefully have an edge and hopefully reduce your risk and increase your yield? I would hope yes, unless you're not very good at your job. So in the self-directed world, if you've got specific knowledge of stuff and you want to take advantage of that, you can take advantage of it. So that invest in what you know deal, that's huge when it comes to people using their self-directed retirement accounts to take advantage of different opportunities there. Increase investment flexibility. You do a self-directed account, that account's going to allow you to own anything you currently own and anything else the law allows. So why wouldn't you want that, right? I mean, and when we look at people when they come to us, depending on IRAs, 401ks, what they're doing, when you self-direct something, it's not all or nothing. So what I'm typically going to tell people with an IRA is leave what you want to keep in Wall Street where it is and self-direct what you want to use in the self-directed world. And the reason for that is we're isolating those two accounts. And as I said earlier, Wall Street, it's impossible. It's possible for you to make a bad investment. It's impossible for you to create a prohibited transaction. In my world, in the self-directed world, it's possible to commit a prohibited transaction. The cost of a prohibited transaction with an IRA is complete distribution of all funds in that account as of the first day in the year in which the indiscretion occurred. So you've got to really be careful every time, like I said, coming right down to the name of that account. We want to make sure that you're aware of what it is, what you're doing, and making sure that it's right, because a prohibited transaction with an IRA, I'll say once again, means that all funds in that account are treated as distributed as of the first day in the year in which the indiscretion occurs. That's why we separate the Wall Street from the self-directed, because the Wall Street stuff's a different account. It's isolated. 401k plans, it's only the money involved with the indiscretion. Totally different repercussion of a prohibited transaction, right? Real investments, not alternative investments. We've talked about that. I look at real estate. I'm a real estate guy. Real estate is a real investment. That's why I capitalize the REAL. It's real. It's not an alternative, okay? Community-based investing. You want to make a difference in your community. You want to do something locally. where you can drive by it and see it, you can do that. All right, that's fine with a self-directed account. The other thing is, if we go down a couple of those, actually, I'll hold off, get to it. I just get too excited. Anyway, community-based investing, take advantage of today's opportunities. What's going on. I've been talking about recessionary times, what happens, those with the gold make the rules, those with the liquid capital to take advantage of changes, you're going to have that advantage, obviously. Tangible assets, great hedges. We're getting beating that horse, right? So, and then finally, security, right? Security. What do I mean by security? Your money is not, cross country with some investment firm you don't know. The money is literally where you put it. If you've got a checkbook IRA, for example, you've got a limited liability company where the member, and we're going to talk about this, give you a little bubble chart later, but a checkbook IRA simply means we're sticking an IRA specific limited liability company between the trust company, the custodian, and the ultimate investment. That limited liability company, the member is the trust company, the manager is the investor. All right, so you literally have a bank account at the bank of your choice in the limited liability company's name and federal tax ID number. You as manager have the power of the pen. But what I mean by security is you put the money where you want to put it in whatever institution you choose, and that's up to you. We've had some, for future context, this is March of 2023. At the beginning of the month, we had some bank failures, and there's talk of other banks that are having problems. So you don't have to worry about where your investment firm has your money. You're going to put it where you want to put it, and that can be literally any bank that's going to accept that limited liability company. And then the final sort of bullet here is just sometimes in recessionary times people get displaced. They lose a job, or maybe they want to make a job change. And it is literally possible to create a new business that you work for using your retirement account. The process is called a rollover business startup, or the acronym's obviously a ROBS. So it's possible. I'm going to say it again. We can take your IRA or 401k. The exceptions would be Roth IRA money or a beneficiary IRA, one that's been inherited. We can't source the 401k with those two forms of retirement account. But virtually anything else can be rolled into a 401k plan. We do the new plan. We do a C corporation. The plan buys the corp buys the business. Now you're working for a company owned by your retirement account. And we've got a slide later that's going to sort of, give you the full extreme example of what is possible with a rollover business startup. So we've talked about this a few times. We're going to talk about it one more time. As far as investment options, that menu, a truly self-directed retirement account is going to allow you to buy anything other than collectibles, life insurance contracts, stock in a sub-chapter S corporation. You name it, your IRA or 401k can buy it. The investment must simply be made for investment purposes. So you name it, you can probably do it. It's really wide open for you. So as I said earlier, you've got two issues. What are you investing in, and who you're transacting between, or for the benefit of? Who's a disqualified party to your retirement account? You are. If you're married, your spouse is. Your lineal ascendant, descendant, their spouses, or any legal entity owned in a controlling interest by one of those. So that's really what we're concerned about. How about siblings? Did you see anything about siblings on there? Siblings are not disqualified parties, all right? So you want to, that example I gave you at the top about you're so excited, you've been hearing our ads about self-directed, you can make these investments. So property came on the market, you write the offer. You can't do it personally, but you could have your brother or sister make that offer and tie it up. That would be fine. They're not disqualified parties to you, nor are cousins, aunts, uncles. So those people are not disqualified parties to your retirement account. Okay, so just really think about that. Who's in your life? If you got to make an offer before you have the account set up, and just for your knowledge, if we're talking about a solo 401k plan, we can get the plan together in a few days, and you figure maybe a week start to finish to get everything there. The thing that's going to take the longest is getting money from wherever it is into that 401k plan's bank account. And if we're talking about a checkbook IRA, it's a totally different thing. A checkbook IRA today could take as long as a month to get funded. All right, so it takes a while to get these things tied up, or put together and funded where you're ready to use them. And that's where people get sort of frustrated once in a while, because they found out and they've been sitting there listening to the ads, and all of a sudden the opportunity comes up and they think, boom, I'm going to go do this, I'll tie it up. And then we say, well, look, you can't do that, it takes this long to put it together. So once again, plan this stuff out, be ready to make the investments when you want to make those investments, instead of getting behind the 8 ball. But if you found something before your account was ready, use a sibling to make that initial tie up the investment, and then we can actually, when your account's set, that account can take over the transaction through an assignment, something like that. All right. So real estate. Okay, I'm a real estate guy. So what kind of real estate can I buy with a retirement account? I can buy rental houses, apartment buildings, office buildings, retail centers, land, any property to be held for investment. Could I buy a future retirement home? And the answer is yes. Okay, and I want to be clear on this. You can buy the property, but anything that's owned by your retirement account, you nor any other disqualified party can use or benefit from in any way. All right, and you say, well, David, you just told me I could buy a retirement home, and yes, you can. I made a comment earlier about in-kind distribution. So if you bought a property with your retirement account, something you ultimately want to live in, or maybe you bought it in some nice retirement area, or just a vacation area, you say, look, I'd like to use these things. That's all possible, but you cannot use them, nor could any other disqualified party use them, until they've been taken out of that account. So you're going to fully distribute that asset before you can use it. So what's the tax consequence of an in-kind distribution? The tax consequence is based upon the equity, the value of what's being taken as a distribution. So the upside of in-kind distributions is you can do them, and a couple other benefits we'll talk about in a little while. The downside is you're taking something out, you're triggering tax exposure without receiving the tax, or the cash to pay the tax obligation. If you take a cash distribution, you know you're going to lose, let's say if you took 10, you're going to lose 3 or 4 of it probably. If you take an in-kind distribution, you're triggering that same type of tax consequence, but you didn't receive the cash to pay that tax obligation. So, a common occurrence is after somebody's taken a property in kind as a distribution, they'll do a cash out refi of it to pay that tax obligation. But it's just something you need to be aware of. And, we'll talk about some other benefits of in-kind distributions in a while. What can't you buy? You can't buy a primary residence. You can't buy a second home. You can't buy a home for a disqualified party. You couldn't buy an office building for your business to be in. And you might say, well, gee, Susie's going to college, and I want to take my IRA 401k to go buy an investment property that Susie's going to occupy. Susie's your daughter. Well, you can't do that. Susie can't be a tenant of a property owned by your retirement account, nor could mom be. Your siblings could be, aunts, uncles, cousins, that's all fine, but you can't have an investment where a disqualified party is using that. And that comes down to the office buildings. Once again, we have, I don't know, for some reason we have law firms that call us up all the time, say, hey, we've got our retirement account, we want to go buy the building, and we can't do that. So just heads up. What are common objections? So if you go out and you talk to your financial advisor about this, or you talk to your CPA about it, you talk to your attorney about it, what are the common objections there? And it's really sort of funny to me, because I don't know, probably 4 or 5 years ago, 4 years ago, I think I was in New Orleans at a Federation of Exchange Combinators meeting. The FEA is the 1031 Industries Trade Organization, and I'm at this conference, and I'm sitting at a bar late at night, and the CPA from Florida is sitting there next to me, and we're talking about 1031s. And he said, well, yeah, you work with retirement accounts too, tell me about that. So they start telling me, and he's like, I don't think it's a good idea. I said, well, why do you think it's a good idea? Explain to me where you see any issue. And he just didn't have anything. I was at a presentation a couple of years ago, and the CPA spoke, and then he came, it was a 1031 presentation for an institutional TIC company, and I was just asked to be there. I was in the audience just listening, and so, you know, once again, the CPA sits down next to me in the audience, and we started talking about stuff, and, you know, similar thing. And it's just, there's so much information that's just wrong. My father always used to say, anytime you read anything about something, you know something about, you know how wrong it is. And there's just misinformation out there all over the place. And this sort of list came to be because I really think there's a couple investment firms that basically in their guide for their brokers basically say, if somebody comes to you and says they want to self-directed, tell them these things, right? So this is typical. First thing they'll say was, why would you want to take your retirement account and buy real estate with it when you lose long-term capital gains tax consequences of a disposition? And that statement's true, but name an asset that you buy with a retirement account that's going to give you a long-term tax consequence, and there aren't any. Okay, I'm going to say it again. Once again, your tax consequence on a retirement account is upon distribution, typically. Not always. We'll talk about unrelated business taxable income in a little while. But typically, you're looking, the tax consequence of a retirement account is as you take distributions. It's taxed at normal income tax rates. Anything you buy with a retirement account is going to have the same tax consequence. So if you're saying, gee, if you could only take money from one source or another, you know, is there a benefit to taking money out of your pocket, go buy a piece of property, for example, over using your retirement account to do that? If you can only do one thing, I'm going to say take the money out of your pocket. But that's not the issue. Really, what you've got in that retirement account, there's only one question there. What's the highest best use for that money, period? And you should be investing in what that is. And you know, and one of the big secrets to, you know, financial advisor world is to have a nice spread of investments, right? You want to have as much spread there for stability as possible. And why wouldn't you want to actually be able to take some of that money and get it into real estate? I mean, it's just simple. That's a secret to success in anybody's financial world. Second one, cannot be leveraged. Totally wrong. Totally wrong. Okay, so you want to take your retirement account and go out and buy a property with a loan. You can always do that. It's just got to be non-recourse debt. What do I mean by that? That loan is not you. It's not to you. It's to your retirement account. There cannot be any recourse to you. If you're a guarantor on the loan, if that loan's attributable to your income, your credit, any of that stuff, that's not something that's IRA 401k compliant. So in a 401k or IRA owned asset situation with leverage, that loan in a default, the only thing that lender can take is that asset. They can't go after anything else a retirement account has. So think of it from this context. You're typically looking at lower LTV, lower loan to value, maybe 60, 65% at most. And then you're also, you know, looking at a requirement of reserves, maybe 15%. It's going to be slightly more expensive money. And they're going to want to know you have some experience managing real estate. They don't want to have, you know, some leveraged investment first time you ever bought stuff. And that 15% reserve, that's something I just want to, you know, really stress, because they don't want you to spend all the money on an acquisition. Anybody that's dealt with real estate knows, you know, you buy it, you're going to put money into that thing to fix it up. So you better have enough money in the account to make the purchase, cover any carrying costs until that thing starts generating cash flow. But somebody tell you you cannot leverage an IRA investment property, totally wrong. They don't know what they're talking about. But don't think that you're going to walk into your friendly credit union, let's say, or your friendly mortgage broker that you work with everything else and get a non-recourse loan. If you're curious about these type of loans, you can type in myiralender.com or iralending.com. North American Savings Bank is one of the big banks in that space, and you can sort of see what they've got there, and you know, they can talk to you about what is possible. What about RMDs? Okay, required minimum distributions, as I mentioned earlier. You know, this is an objection that comes up all the time, and you know, the idea is, you know, from Wall Street world, they think, well, gee, you know, you don't have any money in that account, you got to take an RMD, you're going to be penalized because you didn't take the RMD. In my world, I'm going to just say take an in-kind distribution. So you're going to take a piece of the asset, or we can do a simple assignment of membership interest if it's a checkbook IRA that owns the asset. So a checkbook IRA, once again, means we've got an IRA specific limited liability company that owns the asset. We can do an LLC for your 401k owned assets too. It doesn't really matter. I mean, the plan would be the member of the LLC, or you've got the trust company as the member of the LLC in an IRA context. But like I said, the easiest way to do an in-kind distribution, if it's a piece of property, is just do a simple assignment of membership interest in that limited liability company. So that's sort of our solution. And again, the downside of an in-kind distribution is you're triggering tax exposure. You've got to be prepared to pay that tax obligation. All right. Finally, you lose interest deductions and depreciation. Well, that's once again true, but name any investment you're going to make with an IRA 401k that gives you those things. So once again, yeah, it's a true statement, but it's a pointless statement. So really, when you're looking at people and your professionals in your life, when you're going through these things, if you broach this topic, understand what's going on, and understand what is truly possible. And yes, these things are true statements, but right? But what? But you've got these opportunities or options to deal with them, or they just are pointless statements. And that's the way I would sort of look at this stuff. But like I said, these are 4 statements that come up all the time as objections to doing a self-directed account. How do we do this? All right, any of these plans are going to be, any IRA can be self-directed. Okay, when we're looking at 401k plans, you've got a different situation because, depending on, how old you are, what's going on in your life, if it's a current employer plan, previous employer plan, it's going to make a difference to what's going on. So, if I'm looking at IRAs, any IRA can be self-directed. We do have restrictions on beneficiary IRAs, one that's been inherited, and Roths, moving them into 401k plans. But we can have a self-directed beneficiary or self-directed Roth IRA. Those are fine. If we're looking at 401k plans, if it's a current employer plan, you're under 59.5, you can't get that money out, as I mentioned that person during the last crash. So as soon as you hit 59.5, you can take an in-service distribution. That money is yours to use as you choose. Previous employer plans, you can self-direct any of those as well. All right. So how do we do one of these things? So you've got one of those accounts. You're saying, gee, I'm excited at the opportunities that are there. I want to self-direct. I like what you're saying. How do we do this? All right. So if you're working with us to put a self-directed IRA together, you're just going to let us know. We're going to send out a 2-page application. That application really just asks what kind of account, your information, what kind of account you really currently have or accounts, what you want to do with that money. If we're doing a checkbook IRA, we're going to want to know some names, potential names for the limited liability company, where you think you might be investing, what state of registration we're going to do the LLC in. And by the way, the state registration fees vary dramatically depending on what state you're in. If you're, unfortunate enough to be in California with respect to an LLC, you're looking at almost $1,000 a year for a limited liability company. It's ludicrous. If we're talking about, let's say Colorado might be, I think there's 60 a year, 40 or 60 a year, I can't remember. Washington 60, Oregon's 100. So state to state, it varies. The thing, as far as deciding what state you're going to do it in, it's typically going to be either your state of your state of residency. Can I say that? Anyway, not registration, or where you're going to make the investment. And why would that matter? Well, some states, for example, Texas has different tax consequences for domestic entity versus foreign entity, or foreign investor, domestic investor rules. So you just sort of look at where you are, what you want to do with it, and that's going to dictate what state we do the registration for the LLC in. Another consideration for the state of registration is if you do the LLC in the state you live in, you don't have to have a registered agent, which saves you maybe a couple $100 a year. So just be aware of that with respect to the LLC and what's going on there. So you're going to fill out that 2-page application, get it back to us. We're going to want that along with a current color copy of a photo ID, and in your current account's most recent statement. We're going to take that information, fill it out a variety of forms, get those out to you. That next set of forms we need wedding signatures on, so you got to get those originals back to us, and we're going to bundle it off, get the custodial account set up. If we're doing a checkbook IRA, we're also going to be doing that limited liability company, getting all that stuff handled. And then the bulk of the time is really getting the money go from custodian A to custodian B. One of the forms that you will be signing is a transfer authorization form if we're going IRA to IRA. Now, it's critical that the source of money, wherever those funds are today, you need to go to cash in the amount you want to use, because if that transfer authorization form is utilized and that request hits your current custodian and you don't have the cash to do it, they're going to bounce it, and then we're going to go into a holding period. So you want to make sure you go into cash in the amount you want to use with this account. And that way, when that transfer authorization form hits that account, it's going to move the money. So, the money goes from trust company A to trust company B. If you've got a basic account, really as soon as the account's established, to make an investment, you're going to submit an investment form along with a couple other things to that trust company, and then they'll make the investment. Checkbook IRA is a little different thing. So a checkbook IRA, all right, a basic self-directed IRA works just fine for passive investments or investments that are not time sensitive, something where there's no sense of urgency to get the deal done and or require no management. All right, so a basic account, if you've just got a note you want to make an investment, or you've got a private placement you want to make, a basic account's going to take care of you. That's all you need, and you can get a basic self-directed account together for a couple $100. If you want us to do it for you, we charge $500 to do that. But we're always going to tell you the trust company we use and give you that option to go straight to them and take care of it on your own, because honestly, you don't need us. If you want a checkbook IRA, on the other hand, you do need us. And the reason you need us, and we're not a trust company, we're an IRA facilitation company, we're a 401k facilitator. So we provide the investment vehicle. We don't sell investments. We don't provide investment advice. We're just going to provide the investment vehicle for you to make the investment you want to make. So in the IRA world, we're going to create that IRA specific limited liability company. So in a nutshell, what happens is the trust company does not make the investment in the ultimate investment. They're making an investment into the limited liability company that you're the manager of, and that limited liability company has a bank account at the bank of your choice, and that LLC, you as manager of, have the power of the pen of, so you make the investments as you want, when you want, and you can manage assets and so on and so forth with this checkbook IRA LLC vehicle. It's wonderful. And as far as the source of funds, it could be an IRA, 401k, Roth money, it could be beneficiary funds, any of those combinations can happen. You could combine in that new IRA LLC. It could be a single member LLC, it could be multi-member. David, what do you mean by that? Well, you could have personal money and plan money in that. You could have your IRA in it along with your spouse's IRA in it. You could have your SEP IRA and your Roth IRA as members of that. So yes, each different type of IRA you have requires a different custodial account. And when we want to aggregate those different accounts into a common investment vehicle, you can do that, but we want to make sure that you get what you want into that LLC initially, because we don't really like to see additional funds coming in to a multi-member LLC with disqualified parties as members at a later date. Trust companies will do that, but we prefer that you didn't. We want to overfund. So if you say, David, we need $300,000 to make this investment, I'm going to say, hey, let's put $350 in it. The trust company is going to want, let's say, $500 in their account, and then typically people pay us with that retirement account. I haven't said anything about it. I'll just say it right now. For a checkbook IRA, we charge a one-time fee of $2,300. People typically pay us with the retirement account, so it's pre-tax money. And then your ongoing costs with a checkbook IRA might be, at least once again, today's context, it's March of 2023, and the trust company you can figure is about $380 a year. The state LLC is obviously state dependent, somewhere between $40 and $1,000 if you're in California. If you're doing the LLC in the state of registration, you don't have to have a registered agent. Otherwise, you're looking at maybe $150 to $200 for that. And then if we're talking an IRA, the last cost you're looking at, if it's a checkbook IRA, every trust company has a different, well, let's talk about trust companies for a second. All right. So how do you pick what trust company you want to use? Right. And this is something we haven't talked about. I'm just doing it right now. I probably should have talked about it in the last slide. So obviously cost is a component of that, but you just don't want to pick it based upon cost. You got to obviously understand, and this is more important than ever before. Think about who you're working with in these things, right? If you're working with somebody that's never been through a bad time, you probably don't want to work with them right now. If it's a bank that hasn't been through a recession, you probably don't want your money there. If it's an investment firm that hasn't been through a recession, you probably don't want to work with them, because I sort of jokingly say I'm in my 60s now. I used to have hair on my head, don't anymore, but yeah, I'm always happy to learn. I'm tired of being taught, right? But the bottom line is, when you look at somebody's website, for example, today, and you say about us, I'd like to know about them. I'd like to know how much experience they have. And I really get tired of people, some firms saying a combined 100 years of experience in this, blah, blah, blah. You got 20 people with 5 years, nobody's ever seen a bad day, right? So you don't want to work with somebody that's never seen a recession and doesn't, they're not able to get through it, because bad things happen, right? So we want to make sure that when you're making investments, if they're passive investments with some firm, you want to make sure you're working with somebody that's been through a bad day and understand what's going on there. But as far as these things, the trust company, so you want a trust company that's been through a bad day. But so one cost, you want to have experience there, and you want to understand how they charge you too, because cost is one thing, but how do they charge you? And a lot of trust companies that are going to charge you based upon the value of your account. Now, in the Wall Street context, that's fine, because you got stated values. In the self-directed world, what is something worth? What is a piece of property worth? And if you've been to my seminars before, you know my youngest brother's an MAI appraiser. That's atop the appraisal heap in investment real estate. He doesn't do houses and stuff, but he does big things. And I say, well, hey, Greg, how do you know you've done the right job? He said, well, it's easy. I said, well, what do you mean it's easy? It's like, well, nobody's too happy or too mad. If you have a sale, you've got a buyer and a seller that agree to a given price. That's what's there. But if it's not on the market, what is a piece of property worth? So you don't want to be working with a trust company that's going to be charging you based upon what they feel the thing's worth. Or, for example, the last crash, I had a client with a $1 million note out of Chicago. The note was bad, and the trust company charged based upon the value. So they kept fighting that this thing was $1 million note, and it wasn't worth the paper it was written on. So you don't want to work with a company charging you based upon the value of your accounts in the self-directed world. And so we always look at that. And just in contrast, the company we use primarily charges based upon the number of investments. If you've got a basic account, every investment you have obviously is an investment. But think of it from this context. If you've got a checkbook IRA, they have one investment. That LLC could have 50 investments, but the only investment they have on their books is that IRA LLC. So it's really important to understand what they're charging, how they're charging it, and how you're going to support what they've got. You're also going to want to know what they allow with respect to the investment vehicle you're using. Obviously, a basic account, you want to know what the process or the path of investment is with that firm, what they're going to require for the paperwork. If it's a checkbook IRA or IRA LLC, for example, you want to know what they're going to allow. There are trust companies that will not allow the taxpayer to be the manager of the LLC. There are trust companies that will not, or that will require that your tax or legal people sign a document stating they're experts all things IRA, which they probably don't want to sign. The trust company that we use wants a third-party review of your LLC's activities annually, because your only interaction with the trust company annually with self-directed account is to provide them a valuation of all cash and assets that you have. All right, they don't know what you've got. If you've got an IRA LLC, you're going to have cash in a bank account. You could have pieces of property, you could have gold, you could have any combination of stuff there, but somebody needs to, one, provide a valuation to them annually of what's in there, and then two, the trust company we use wants you to, be telling them that yes, your tax counsel or your legal counsel, or we as the organizer can do a review of your annual transactions. So we do a review for our clients annually, those that want us to, And that review is really there to find a problem that hopefully can be dealt with and taken care of before it becomes a problem. So each trust company is different, and that's why it's important to understand you're not going to just use the cheapest one. You're going to want to use the one. And the other thing is, how available are they, right? I mean, you call up, you sit on hold for an hour, 2 hours. I mean, it's sort of ridiculous, but there's a lot of businesses these days that, oh, we value your calls. It's automated machine answering the phone. So anyway, understand who you're dealing with and whether you have access to information that's going to be helpful to you. And the Checkbook IRA LLC really is a wonderful vehicle because your only interaction with the trust companies provide them the valuation annually and the review annually, and you're able to do whatever you want to do. The downside of a truly self-directed checkbook IRA is if you want to blow it up, you're going to blow it up. And in addition to that example of tying a property up personally and then assigning it over to the plan at a later date, if you go pull money out of your pocket to pay for something that the IRA owns, that's a prohibited transaction. Making a contribution to your IRA, if you've got an IRA LLC and you just write a check to the LLC as a contribution, that's a prohibited transaction. Taking a distribution directly from the LLC to you, that's a prohibited transaction. Everything needs to flow. If it's a contribution, it's going to go from you through the trust company, and an additional investment is going to be made in the LLC. If you want to take a distribution, it's going to go from the LLC through the trust company to you to get out. So it's one of those things where, like I said, every time you pull out that checkbook, every time if you've got a debit card, you're thinking, okay, make it a name that you know is not you, and you don't treat these things as yours, you treat them as yours. An example would be you buy an investment property and you just add that investment property using your checkbook IRA, you just add that investment property to your current homeowner's policy. That's a prohibited transaction because it's not yours. So you need to get a new policy in the LLC's name and federal tax ID number for those assets. But this structure was derived from the Swanson case in 1996. It's not new. It's been around for a long time. It works great, and it's just, it really gives you the flexibility to do what you want, when you want, as you want, and it's a great tool. So what's your other option? You're self-employed. I'm getting past this. See, I get so excited anyway. Checkbook IRA, we talked about that. You're self-employed with no employees. I'm going to do solo 401k plan for you instead for a variety of reasons. I mentioned UBIT earlier, or UBTI. I mentioned having tax on leverage. And if we look at an IRA-owned asset, if you've got an IRA-owned asset, it's owned half with equity and half debt. So you go out, you buy the property, it's a $500,000 property, you put $250 in equity, you got $250 in debt, and it's an IRA. Well, the income or gain attributable to leverage, attributable to that $250 loan, that's going to have tax exposure. The equity component does not. And you say, well, David, I've got a Roth IRA, I don't have any tax on anything. Wrong, you do. You're going to have the tax on that leverage with an IRA. The other time you're going to have tax exposure with an IRA or 401k is if you are conducting business with it. So a common occurrence might be this: you have a couple of rental houses, and then you snowball it into an apartment building, and the apartment building's got a laundromat, and you go, boy, that laundromat's making me great money, I really like it, so I'm going to take my retirement account and go buy a laundromat. Well, the laundromat as a component of the apartment building's an investment. The laundromat standing on its own is a business. So you're going to be subject to that unrelated business taxable income if you're conducting business. Flipping properties, for example, another situation where you're going to have tax exposure. In the 1031 world, I use the Clarkowski court case, 9 points used to determine dealer status to qualify a property for 1031. I use that same court case and those 9 points when we're looking at whether something's going to trigger tax on that unrelated business taxable income with a retirement account. But I'm going to say this again, with an IRA, you've got tax on leverage. With a 401k plan, you do not. So that's one of those huge benefits that a 401k plan has over a self-directed IRA. Another benefit is that with a self-directed IRA, as we've discussed, a prohibited transaction is complete distribution, all funds in the account. With an IRA, where it's only the money involved within discretion with a 401k plan. So two different consequences, the same action. And another benefit of the 401k plan is you don't have a trust company. So with a 401k plan, you're going to have a plan, you're going to have the tax ID number for the plan, you're going to be the trustee of the plan, so you're going to have a bank account at the bank of your choice's name, in that plan's name and EIN. You as trustee have the power of the pen. So it works just like a checkbook IRA without a trust company. And once again, I'll stress this: if you've got employees, then you can't do that solo 401k. But for like a real estate broker, another benefit is, maybe you and your spouse work the firm together. If your spouse works to the tune of a few $1,000s a year, you and your spouse can both be participants of that single plan, and it really allows you to combine the power of the two accounts into common investments. So I really like it. As far as reporting, as I said, with an IRA annually, you're going to provide valuation, call all cash and assets to the trust company. You're going to provide them that review, or tell them you've got the review done. With a 401k plan, if you've got under $250,000, it's no reporting. In excess of $250,000, you're looking at a form 5500 EZ, which is a pretty simple form. A lot of our clients just do that on their own. So we talked about this earlier, just real quick, then I'm going to get on to a few examples. We'll wrap it up. So examples: prohibited transactions, borrowing money from your IRA, selling property to your IRA, unreasonable compensation for management. I'm going to say there should be no compensation for management. This is my lawyer speaking, because you can't have sweat equity. So we really didn't talk about that. But if you've got an IRA-owned asset, you can't. It's not that you just can't use it. You can't work on it. So don't think, hey, I'm going to buy these properties, I'm going to flip them, I'm going to go out and paint them, roof them, do whatever it is. You cannot work on a property that's owned by your retirement account. And you go, well, that doesn't make sense, because, honestly, I get it. I mean, because if you look at working or sweat equity on a property, what you're doing is increasing the value of the account without a corresponding expense. At the end of the day, you're paying tax on the value, the aggregate value of the account, as funds are being pulled out, right? So, and the RMDs are going to calculate that whole ball and break it up into whatever the life charts say in a given year. But if you look at, so you're saying, well, why would the government care? Why wouldn't they allow that sweat equity? Because it's just good. It ultimately leads to more tax revenue. And I get that, but I think, I've thought about this for a couple decades now, and I think the only rational reason I've got for it is that they don't want to forego your payment to the vendors to get the work done, foregoing taxes today for the promise of taxes in the future. That's the only thing I can really, look at. But there is, truly a benefit to a disqualified party if you're working on the thing. So don't think you're going to buy these things and work on them. You can't. You're going to hire people to do all that stuff. Selling property, your IRA, unreasonable compensation for management. Like I said, I don't want to see any compensation. They're using your IRA as security for a loan. Can't do that. Buying property for personal use, can't do that. Mortgages, we talked about this, got to be non-recourse debt. So don't go just to your regular lender and expect he or she to give you that loan, because it is something that has to be IRA 401k specific. Keep in mind that if we're looking at, let's say you do a checkbook IRA and you want to just open an account at your friendly credit union, thinking, well, gee, I've got accounts there, it's just another account for me. It's not you. If you've got a checkbook IRA, the trust company's the member of that IRA LLC. So you're not going to get the trust company to join that credit union. So you just got to be working with a bank that's going to allow these things to be done. So buying a property, as I said earlier, you've got to tie the thing up with a non-disqualified party. But if it's an IRA LLC or 401k, the 401k plan's the buyer, the IRA LLC is the buyer. If it's a basic account, then I really don't know how you get it done, because technically the purchase sale agreement is going to be between the seller and the trust company for benefit of your IRA. So when you look at an IRA account with the trust company, it's going to, if it's mine, for example, it would, whatever the trust company's name is, CFBO, custodian for benefit of David Moore, IRA, whatever it might be. Okay, so do I have the power of the pen for the trust company? I certainly don't. So if I need earnest money, where does that come from? And that's just one example of why the IRA LLC is so important, because you're just simply negotiating a deal between the seller and the IRA LLC that you're the manager of. You need earnest money, you write a check. You go close it, you write a check. If you got a solo 401k plan, the thing's going to work the same way. You're writing an offer between the seller and the 401k plan. You as trustee have the power of the pen. You write a check for the earnest money. You write a check to close the deal. So, it's pretty easy in those situations. If it's something where, depending on the type of account, as far as additional contingencies, a basic account, you want to make sure it's got something in there stating that the purchase is subject to the custodian's approval. If it's checkbook, IRA, or 401k, you don't have to have that in there. If there's financing, even though the state forms typically have financial contingency in the purchase sale agreement, it doesn't say anything about IRA 401k owned assets and IRA 401k compliant loans. So I would put something else in there additionally, and then once again heed that time that's required to get things done. A few examples, and we're going to wrap up. Of course, always we're a little over time, but I talk quickly. I try to get it done. I'm just the eternal optimist. So, in this situation, this is actually, I always like this slide, and I've used it for a long time. This is one of the guys that was responsible for our IRA ads, and actually the creation of the IRA business, because he kept saying, you ought to do this, you ought to do this is a great idea. But anyway, he was an early client, and he took a piece of his retirement. Once again, I want to stress it's not all or nothing. So he took a piece of his retirement account, and he had a friend. This is the last crash, actually. He had a friend that had a bunch of lots down at the beach, and the guy was really having a hard time not being able to sell them because nobody had any money. So he thought, look, I've got the ability to tie up, diversify my IRA holdings or 401k holdings into this stuff. And I think that's a good thing. It's a good opportunity to buy this land at a discounted price, and I'm helping a friend. So that's how he sort of dipped his toe in the water. After that investment happened, he started asking around, and we're doing these ads, and he started saying, well, we've got these people, those people doing all these different investments. And one of the investment firms we do a lot of work with had tied up a property in Boise, multifamily project tied in with BYU. And at least at that point, it was interesting because BYU would withhold a kid's diploma if they weren't current with the rent. So it was a very nice deal. Anyway, so he said, well, look, I'm going to take some more money. So his was a single member checkbook IRA. So we funded it with enough to make that lot investment initially. And then we moved, he moved more money into that IRA LLC at a later date and ended up buying into that multifamily project, which worked out very well for him. And after that, he ended up buying some condos and some other things. But a lot of times people sort of say, I don't know, I'm going to like it, or what's going on with it. So I'll start small and then, dip your toe in that proverbial lake and then go forward with it afterwards. This is a situation, once again, last crash, and this is where dirt was literally dirt cheap. So we have a property developer that's looking at the values of land, and something that had been worth a lot of money a year later is suddenly worthless. And so he said, look, can I take my retirement account and go out and land bank? And the answer is yes, but the issue was that at some point he wanted to build on them. So, could he buy these properties with his retirement account and then at a later date build on these things with his development company? The answer really is no. So that would be a transaction between disqualified parties. So what we ended up doing is we created the land bank entity, and then we created another limited liability company at a later date. His ownership of that second limited liability company, which was the development company, he put the vendors in it in addition to himself, knocked his percentage of ownership of membership in that LLC down to 1/6. Therefore, it was no longer a disqualified party to his checkbook IRA LLC. And as things were to be built, they'd move them to the development entity and then build them out. And they just kept rolling the land banking. And also, I just want to mention that we've got a number of builder developers that have put investment funds together, and they're using people's IRAs to fund those investment accounts that then go and do the same thing. So this is something that just, in the banking world, there's lots of red tape these days, and people are always looking at other ways to diversify their real estate or diversify their retirement accounts. And that's something that we're seeing done more and more through the years, is just using personal money to provide, an investment fund that then provides the capital to do development work. And if you have questions on this stuff, give us a call. So this gentleman, I love this guy. He had institutional medical clinics, and he came into us, and Leroy was a guy who could never get to really sit down very long, and that was probably the secret to success for him. But he called up one day, and he said, "Hey, you know, I want to go buy this mobile home RV park, and with my retirement account, can I do this?" And then we started talking about checkbook IRAs, and I asked him if he wanted me to send him anything. He said, no, I'm heading up your direction in a couple of months. We'll just talk then. The next day he calls up, "Hey, can I buy notes with my retirement account?" And I said, "Yeah, sure, fine." And this once again was the last crash. And so his first investment, I mean, you think about, you know, any of you that have been looking at property in Palm Desert lately, you think what it costs today, but you know, that last crash was brutal. So, I mean, he found, he has a mortgage broker friend down there that was going to sell him a note, a first on a condo that was selling for $70,000, 50% LTV. The property pre-crash had been a couple $100,000, but it was selling literally for $70,000, and the cost of capital was going to be 11% at that time as a first. And my general rule on notes is never anything but a first, and never for anything more than you'd be happy owning the asset for. So once again, tipping his toe in the water, and you know, understanding the terrible T's, toilets, trash, tenants, turnover, he had enough doors, so he didn't want to deal with that stuff with the retirement account. So these notes really were attractive to him. So the first note was this one, and then ultimately he ended up moving several $1 million in retirement funds through us, through the checkbook IRA. And I think the best investment he ever made was a wind power plant down there. And I think they wanted about $1 million paying. It was like 19% on the thing. And once again, it was only like a 10% LTV loan or something like that. So he was just cheering them on to default in that situation. But you know, once again, if you're not sure what you want to do, start small, see how it works, and move stuff as you get more and more comfortable with it. This is the last example, and then you're free. This is something that I give in pretty much all my presentations. I just love the example, and all of these are like I said, true cases. We like to say it's not a deal, it's a story. You know, it's not an exchange, it's a story. It's not a, you know, somebody's given investment. It's a relationship here that creates stories. And this is an elderly couple, retired. They came to us, said, "Hey, you know, we understand we can do a self-directed IRA and go out and buy, we want to buy this mobile home RV park." I said, "Yeah, fine, we can do that. We'll do a checkbook IRA for you." And then they mentioned they wanted to be the on-site managers. They wanted to live there. So they wanted to be compensated to live there. So, okay, whoa, we can't do an IRA for you. That would be a prohibited transaction. Even if we use a 401k plan, it's once again, there's a benefit to a qualified party. It's a prohibited transaction, but don't panic. We've got the rollover business startup as that last option. So instead of doing IRAs or 401ks, we combine a checkbook IRA as a combination of an IRA and a limited liability company. A rollover business startup is a combination of a 401k plan and a C Corp. So we moved his and her IRAs into the 401k plan. The 401k plan bought the bought the corporation. We require our clients to also be shareholders of that corporation. So the corporation is funded, the corporation bought the park, they got obviously an investment with a retirement account, they got a job with a retirement account, and they ultimately got a place to live with their retirement account. So I really just think that is a wonderful example of all that is possible. And so never say never. You know, ask the questions. As I said earlier, the only dumb question is the one that's not asked. So I'm going to leave you with this. Plan ahead. Takes 2 to 4 weeks to get things together. Purchase all types of property with this IRA, SEP, IRA, Roth, or 401k. You can purchase with family members and friends. You cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy a property with a mortgage. Negotiate from the deal's inception in the IRA or IRA LLC's name or 401k plan's name. Do not overextend. Plan on keeping nice cushion reserves. Real estate is real investment. I thank you very much for your time today. If you're not on our email list, which you're probably on this because you are, but if you'd like to be on the newsletters, please reach out to CMOORE, C-M-O-O-R-E at IRAadvantage.net. Please take a look. If you got questions on different aspects of 1031s or IRAs, take a look at our YouTube channel. Please like and subscribe. It really helps us out. If you're looking for information you don't see on one of those 2 sites, please let us know. We're always looking for content. If you've got questions, we'll provide content via the seminars and or videos. And I just really look forward to working with you in the future. And if you've got questions, even if you're working with somebody else on something you're not getting an answer on it, please don't hesitate to reach out. Thank you for being here today. Once again, David Moore, IRA Advantage, IRAadvantage.com. Take care. All my best. Look forward to talking with you soon. Bye-bye.